$10 property.
Partnership.
I contributed property, $10 carryover basis, and then $50 fair market value.
Okay, we're gonna have the facts. $10 basis, $50 fair market value. What happens next, Anna?
Then I decide to take a withdrawal of.
Remember, you can't decide. The partnership decides to distribute what to you.
Yes, exactly. That's right. So let's say then the withdrawal happens of $60.
How much?
$60.
60.
Oh no, or 50. I'm sorry, 50.
$50 withdrawal. Okay.
So I withdrew in excess.
Not we. The partnership distributed to you $50.
Okay, so the partnership distributed to me in excess of my outside basis.
Right.
So we were saying that that would be a taxable event.
Right. You're gonna have a gain recognition of $40 and a zero outside basis.
Correct. But what if this property was a subject to recourse liabilities? Would I have to, let's say, $50 of recourse liabilities?
Are you accepting the recourse liability?
Yes, I'm accepting it.
Okay, and how much is the recourse liability that you're accepting?
Well, let's say $100.
No. I mean, don't just say it. I mean, did you say that the property you contributed had a $10,000 basis worth $50,000?
Yes.
Something like that?
Yeah, so then liability.
And if the liabilities were $20,000, then your net distribution was really $30,000, right?
Correct.
We'll get into that on it. Tonight it's too much to absorb. I don't want to go there.
Just the point is that if I have liabilities to cover my distribution in excess of outside basis, then I wouldn't have to recognize
It gets much more complicated than that. So let's not go there tonight. All right, guys, let's do the problem on page 82. Okay, so there's a whole bunch of items here, and let's just look at what has to be separately stated here, okay? Because Code Section 702 says on the K1, certain items have to be separately stated. All right? So maybe you guys want to check off, just test yourself. What items do you think need to be separately stated? Just put a little check mark and let's see if you get it right. Take 1 minute. All right, you separately checked it. Okay, item 1, interest expense. Okay, interest expense. Okay, $6,000 has to be. Why? Because interest expense, there's limitations under Code Section 163D that individuals can only deduct up to the amount of interest or investment income. So this would be a separately stated item. Dividends. Dividends. Okay? That too, of $7,000, separately stated. Why? Because taxpayers have special rates. Corporate partners get a 243 deduction, if you remember. So dividends are separately stated. Code Section 1231 gains, separately stated, because why? Individuals have to decide if the gains exceed the losses or the losses exceed the gains, right? So they're separately stated. Short-term and long-term capital gains have to be separately stated. also casualty gains and losses have to be separately stated. If you combine this, these items, what you find out is you have $12,000 of income right here, right? If you combine these. I will call to your attention that you don't get a charitable deduction. Why? Code section 703A2C. I'll repeat. There's no charitable deduction. What's by authority? 703A2C. But charitable deduction will pass through under code section 702A4. I'll repeat. 702A4. So charitable deduction is not permitted here, but the taxpayer ultimately, it will pass through. Tax exempt income is not included here. Okay? Not included. Code section 103. The remaining items are combined. No, by accident. Yep. Yep. So the remaining items that do not have to be separately stated include gross receipts from sales, which equal 100,000. Cost of goods sold, salaries, depreciation, advertising, 1245 gain. Okay? 28,000. So what's the taxable income? It's the combination of the 12 plus the 48. Taxable income here is 60. Okay? So each partner must include on his 1231 return. The partners are calendar year taxpayers, and their 1231 return have to include their pro rata share, the partnership that ends 1231. And obviously the partner is not the partnership liable for tax. What's my authority? Code section 701. Question B, assume this is the first year the partnership operates. A's basis in his partnership interest is 70. B's basis in her partnership interest is 40, right? Alan, inside or outside basis here? Outside basis, right? And what code section Alan likely got to them, these numbers? What code section number? Say it loudly. 705? Or Simi, what number? Not sure? Isabel? Say again?
722.
722, right? This were a 721 transaction. Right there, Dolly? 722. Holding periods depending on 1223.1. Right, just go back. Right? You got 722. Just have little graphics for each chapter. All right, guys, take 2 minutes. It helps if you try this. Tell me what is A's basis and what is B's basis at the end of the year. Okay, given these facts, what is A's basis, what is B's basis? Take 2 minutes, do a computation, see how close you get to the right number. Maybe you'll get the right number. Pretend it's an exam and I ask, what is the tax basis? Don't say it loudly. Just try it out. Take 2 more minutes. Try to get the right number. Those watching on WebEx, try it out. All right, guys, hopefully you got the right number. All right, let's think about this. There's certain things that increase basis and certain things that decrease basis. What's my authority? Code section 705, right? So first we have to increase basis, right? By certain things. So let's talk about that. And what we have to increase it by is the separately stated items, okay? Now, the separately stated items, guys, don't get flummoxed by this. How much is the income of the separately stated items? And you might initially say 1/2 is 6,000, but bear in mind, when you look at only the income items, don't take into account the interest deduction. So if you don't take care of the interest deduction, right, the income is 18. Everyone see that? If you ignore the interest, the total here, the 7 plus 2 plus 6 plus 2 plus 1 is 18, right? Yeah. So if we're going to increase basis, first 705A1 says increase it by the separately stated items, right? Which is 9 plus 24. Where did the 24 come from? 148 divided by 2. So that's an increase of 33. Right? Do we increase it by tax-exempt income? Yes, right? How much is our tax-exempt income? $250, right? How much is our, now we have to decrease it by what? First it says decrease it by non-deductible items, things that are not deductible. And if we look at the non-deductible, it includes the charitable contribution. In this case, that's going to reduce the outside tax basis by 400. And then we also have to decrease it by the share of separately stated items, which remember is the interest. So we have to deduct $3,000, right? That's the interest. So what's our deductions here? Or I should say, what's the total basis adjustment? $29,850. That's per partner. So A's basis, guys, A's adjusted basis becomes equal to what? 99,850. Then I think you said that, but maybe I'm wrong. Maybe I'm dreaming it. B's adjusted basis is equal to 69,850. All right? Again, what we did is break out the separately stated items. The remaining items can be grouped together. And then the addition is the separately stated items plus 1/2 of the remaining items. It's at $33,000. But then we have to take care of tax-exempt, non-deductible items and the separately stated deductions. So question B, or excuse me, that was question B. And then question C says, what would the result be in B above if the partnership distributed $20,000 in cash to each partner at the end of the year? What effect does a distribution have? Yeah, the basis would each go down by $20,000, right? And what's my authority for the basis reduction by $20,000? It's code section 705A2 and code section 733. So you would just reduce it. A's basis would become 79,850 and B's basis would become 49,850. Would it matter if the 1231 gain on the sale of the machine would have been ordinary income if A had sold it individually? No, it does not matter, right? We have that revenue ruling that it's the partnership. It's in the hands of the partnership, not the hands of the individual. That's the revenue ruling that the authors include. Revenue ruling 68-79. If you want a somewhat, I'm not going to call it a funny story, but some of you know that for years, this goes, now I'm going to date myself. I have always been a big advocate of accurate tax basis reporting. And many of you know that I played somewhat of a role in code section 6045G, which requires tax basis reporting for marketable securities. All right, because prior to 2008, there was no tax basis reporting for marketable securities, and when it came to tax basis reporting, what did people do? Sort of guesstimated, right? And whose favor did they guesstimate? Theirs or the government's favor? Now we know what happens, right? So I wrote several papers, and ultimately Congress passed legislation, and I think the country's better for it. And then I said, gee, we're on a roll here. We should really have, how many people, how many of your clients do you think really know the tax basis they have in their partnership interest, guys? Zero. Okay. That's not a very optimistic approach, but it's not, how do I say, a healthy percentage that really know the tax basis, right? And I actually got the National Taxpayer Advocate to, in one of her legislative recommendations, to suggest to Congress that, hey, let's extend basis reporting to partnerships and S corporations. Just S corporations is another one where accurate tax basis reporting is kind of abysmal. right? Because the basis, right, fluctuates from year to year. And if you make a mistake 10 years ago, that mistake just gets perpetuated, right? Everyone agree? And good luck to you if you're the new accountant figuring out the mistakes that were made years ago. My understanding, I don't do tax returns, but starting, Ben, you were going to say?
It'd be tough though too. If you had one partner, partnership that maybe had like something wrong with their tax basis, you assume every other partner, where you have a partnership, partner would have something off as a result.
Right.
I mean, that'd be next.
See, what I would do is I would require the partnership to keep track of tax, centralizing, as opposed to individually having each partner determine his or her or its tax basis. You were going to say? Yeah, they're supposed to now. I don't know how. Treasury Department recently, in the form itself, supposedly you're supposed to keep track now of tax basis. That it's supposed to be a reportable item. You're supposed to report it. See, in yesteryear, there was no requirement to even report it, so it was sort of like as needed, which no one does then. But now you're supposed to actually report it.
But I understand it's only negative tax basis that you have to.
And I think it's universal, but we could, my point is, guys, tax basis determination is not easy. But you guys, I'm hoping, will become proficient. Here is an example of just the ebb and the flow of tax basis, okay? So just bear that in mind. If you have questions, go back through this this weekend. And if you have questions, let me know, okay? Page 83. We are beginning something very exciting, something that comes up in people's tax practices all the time. Code Section 199A has been referred to by many tax commentators as maybe one of the worst code sections ever enacted. So that's not an easy title, moniker, and it's certainly one of the most complicated. All right, and what Congress was trying to do with Code Section 199A is say, gee, we're giving a tax break to corporations in the form of a flat 21% tax rate, where the highest corporate tax rate used to be 35%, it's now 21%, right? But what are we doing for Main Street? We have to offer Main Street, the little guy, a tax deduction. But the little guy isn't so little necessarily. And what this effectively does is, if you do a 20%, just keeping it real simple, if you give a 20% deduction and the taxpayer is at the 37% marginal tax rate, they're effectively paying 80%, right? Everyone can handle that math. 80% of 37% is, I believe it's 29.8%, right? So effectively, many people who earn lots of money are effectively could be taxed if they meet these qualifications at 29.8%, where people who work for them might pay a larger percentage of tax between their income tax and payroll taxes. So, we're not going to get into the equities tonight, whether or not this makes from a policy perspective, but given its complexity and given to whom it inures to this tax benefit, should it be in the code? I'll say that rhetorically. Anyone have a strong opinion before? All right. So anyone specialize in Code Section 199A, have a lot of experience with 199A, have had it come up in their practice a lot? I would imagine some of you have. Not an expert yet. After tonight, right? All right. So the authors, let's just walk through this a bit. And my goal line is not to make people experts, okay? But just to have a working knowledge of Code Section 199A, because it's going to come up in partnerships, okay? So you get a deduction for qualified business income. The authors talk about, and I made a mistake, it's not 29.8, it's 29.6%. is they give it an introduction. What is or why did this code section come into being? Then they define qualified business income beginning on page 84. And qualified business income is not salary income. Okay, let's make clear. You cannot get this deduction for salary income. And you cannot get this deduction relating to passive income. Okay, so neither salary income nor passive income qualifies. Generally, capital gains are not part of 1231 computations, capital gains. So if your 1231 gains exceed your 1231 losses, they're not considered qualified business income. However, conversely, if you recall, if your losses from 1231 exceed your gains, that is ordinary losses, and it will qualify as 1230, will be taken into account for 1231 purposes. Income from services, beginning on page 85. Wage income. The authors make clear, if you look at footnote related to footnote 57, wages are not qualified business income. So W-2 income wages paid by employer do not qualify. On page 86, the authors say, 4 or 5 lines down, in contrast, income earned by a sole proprietor or independent contractor generally may qualify for qualified business income treatment. And if you're the owner of an S corporation, assuming you're being paid a reasonable salary under Code Section 162, anything else could qualify as qualified business income. And on page 87, when it comes to partnerships, your partnership income can qualify as qualified business income, as long as, again, on page 87, 9 or 10 lines down, it says Section 199A provides that QBI does not include guaranteed payments, because, well, we'll see our guaranteed payments have an aroma very similar to salaries. And to the extent provided in the regulations, which relate to what are called 707A payments. All right, so those two payments, which we'll learn about both more as the semester unfolds, do not qualify for Code Section 189A treatment. So qualified business income, guys, is a good thing, right? Because if you have qualified business income, you may only have to pay tax on 80% of it, right? So the more, the merrier. So beginning on page 87, the authors talk about determining, how do we determine the deduction? Well, on one hand, it's very simple. You get to reduce your qualified business income by 20%. But nothing's that simple, right, guys? The first limitation we meet, and this is on page 87 after the first full paragraph, 4 or 5 lines down, starts off, overall, the Section 199A deduction may not exceed 20% of the excess of the taxpayer's taxable income determined without regard to the Section 199A deduction reduced by net capital gain. So what this means, guys, is that beyond just qualified business income, you can't deduct more than whatever your, and we're going to see an example of this, the taxpayer's taxable income. So in other words, once you take into account the standard deduction and other factors, the 20% limitation or 20% deduction it's got to be the lesser of the qualified business income or the taxpayer's taxable income. So you take 20% the lesser of the 20% of the taxpayer's qualified business income or the taxpayer's qualified taxable income. So the taxpayer's taxable income. So it's going to be the lesser of the two. And the authors offer an example of how this comes into play. This is all new material, right? So if you have an earlier edition of this book, you don't have this material because this is all come into effect in the year 2018, right? But it's well written. I have to commend them. I think it's pretty straightforward. All right, beginning on page 88. So we had the general rule, 20% deduction, the lesser of 20% of the qualified business income or the taxpayer's taxable income. But then we have limitations, right? It's the Internal Revenue Code after all. So we're going to have limitations for high income taxpayers. What's high income? It's defined as income in excess of $157,500 for single and $315,000 for married. It gets more complicated. Don't look, don't be disappointed if I don't ask complicated, questions on the midterm or final. Keep it really straightforward. We're not going to deal with the phase in or phase out, depending on how you want to. So don't look for, how would this apply, because there's a phase out with respect to individuals, $50,000 above that. For married couples, it's $100,000 above the threshold, or $415,000. But don't look for the phase-ins or phase-out kind of questions. Okay, so what are the limitations if you exceed those thresholds? Well, there's two limitations. The first, which will be enumerated on page 88 going on to page 89, is a limitation for specified service trade or businesses, trades or businesses, okay? So at the water cooler, you may want to talk about an SSTP. That's a specified service trade or business. Is that if you're in that specified trade or business and your income exceeds that threshold that I discussed, you don't qualify for the deduction. Game over, okay? You do not qualify for the deduction. And those are spelled out on the top of page 89. So if you're involved in accounting or law, guys, not going to happen. You're not going to qualify for the deduction. Okay, there's a whole list, and then they say somehow the lobbying for engineers and architects are not subject to this limitation. So they apparently carry more gravitas than us accountants and lawyers, right, guys? All right, so game over if you exceed that threshold and you're in that specified service trade or business. All right. But then there's a second limitation. This is spelled out on page 90. And this limitation says that your deduction is going to be capped by, and this is page 90, the paragraph at the bottom, you'll see it 4 or 5 lines down, is limited to the greater of 50% of the W-2 wages or 25% of W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition of all qualified property used in the trade or business. What is qualified property? That's spelled out on page 91. It's about 10 or 11 lines down. Qualified property encompasses depreciable tangible property, real or personal, held and available for use in a qualified trade or business at the close of the taxable year, which is used in the production of a qualified business income, which is depreciable, for which the depreciable period of the property has not ended before the close of the taxable year. Okay? So what the authors point out, I thought was a nice summary here, is that, remember, it's one of these two limitations are going to apply. And what the authors point out on the top of page 91 is that for labor-intensive businesses, it's apt, the greater of the two is apt to be the first for labor-intensive businesses. And for capital-intensive purposes, you're apt to get a larger dollar figure, meaning a larger allowance under the second two. So that when you look at, and we're going to go through an example or two the authors present, so just bear that in mind. This may not resonate with you initially, but at the top of page 91, there's two, remember, there's two tests, two limitations. You're allowed to use the greater of. And for labor, it's apt to be the first limitation is going to produce the better result, meaning the greatest deduction. And for capital, for businesses which are capital intensive, the second limitation is apt to produce the better result. And the authors finally point out on page 91 that it's going to be an apportionment rule. Each partner is going to be looked upon as if they own a pro rata share of the particular business, okay? So each partner, this is going to not be an aggregate, it's going to be just like chapter 1, it's going to be treated as a conduit principle. We're going to look through each entity and it's going to be a pro rata amount. Now, a lot of this for the moment is going to sound like gobbledygook, okay? I can appreciate that. But if you, this weekend, or even tomorrow, let me not stop you, look on page 92. There's two very straightforward examples. Hopefully you can follow these examples so they're useful to go through. And I have to tell you guys, in my textbook, what I've done is anywhere I see the word lesser of or greater of, I tend to underline it, okay? Because those are key phrases, and this gets confusing because if you look at the statute and you look at these rules, it refers to the lesser of, but then you get to choose the greater of. So it's important, at least I think, to highlight some of these words so you have a better command of them. All right, so we've said enough. Let's just see on page 93. Let me offer the opportunity to go through a few more examples and see how comfortable you are with this. We have Andy is an electrician who generates $140,000 in gross income from his sole proprietorship. He incurs $20,000 in expenses in connection with his business. Additionally, he earns $2,000 of interest and $3,000 of dividend income during the year from his outside investments. Assume Andy is single, claims a standard deduction of $12,000, and has no other tax items for the year. Does Andy qualify to take a Code Section 199A deduction and determine the amount of the deduction? So just take 1 minute. If you don't have time, take 1 minute. Just throw out some numbers, guys. Can he take a deduction? If so, how much? Hint, hint. He can, okay? He can. Why? He's not getting wages, right? Everyone agree he's not getting wages. And his income threshold, he's not subject to the limitations because his income threshold doesn't exceed that specified under the code. Do we have a number of what our friend Andy can deduct? Just throw out a number.
24.
24, I hear B says. 24, anyone have a different number? So is 24 de jure? All right, so let's just talk about this. How much qualified business income does he have? B?
140. Well, sorry, 120.
120, okay, everyone agree?
Yes.
And everyone can handle the math that, remember, let's just say it's the lesser, in this case, remember, lesser of qualified business income, which is 120 times 20% equals 24,000. Right? That's a nice deduction, right? Everyone agree? You just earned, your keep for the taxpayer. You secured a $24,000 deduction, right? But is that the right number? Remember, there's a limit based on his taxable income. And his taxable income, guys, what was the number? Well, no, don't we start off at, he has taxable income of 125 minus 20, right, the expenses, right? Minus 12,000, right, the standard deduction, and that equals 113, right? And he has dividend and capital gains, or dividend income treated as capital gains, right? Aren't we told that in the problem that Andy has $3,000 of dividend income? Okay, and we I'm sorry?
The 145, why did we say 145?
Is-
145 being unit, right? Should it be
145 includes the 3 and the 2.
Yeah, it's the 3 and the 2, right? That's all. And you have to take out the capital gains, right? So, I mean, his gross income is 145, right?
Yes.
So he's going to be taxed on 145, but then we're told to reduce by his expenses and reduce it by the standard deduction, and we're supposed to back out anything treated as capital gains. So it's 110 times 0.20, and in this case that equals 22,000. So the deduction, guys, is 22,000, not 24,000, right? So again, where did I get this from? If, just for your notes, I'll just call to your attention that right at the introduction, oh, I know. On page 87, I read to this before. On the first full paragraph, 6 or 7 lines down, overall, the section 189A deduction may not exceed 20% of the excess of the taxpayer's taxable income. And look at the parenthetical. Determine without regard to the code section 189A deduction reduced by the net capital gain. And so that's where that's coming from. All right, so here we're just seeing a simple example where you got to be careful because Congress doesn't want to be overly generous. You can get 20% of your business income, but it can't exceed 20% of this, I'll call it modified taxable income. So the deduction here, still not too shabby, $22,000, right? Question B. What result if Andy does not operate as a sole proprietor, but instead earns $120,000 in compensation income by working as an employee? No deduction. And that becomes a little silly if you don't, from a policy perspective. It just happenstance that he's either working on his own or he's working for a company. I'm not sure if anyone in this room, certainly I can, justify a tax difference between the two.
They're trying to encourage business.
You know,
No, it's good.
is it worth the complexity? I mean, I would just say, if you want to achieve, just give a lower rate to everyone, as opposed to trying to single out entrepreneurs for special tax treatment. Because I don't really know if this causes people to be more entrepreneurial than they would be otherwise.
But it inspires them to hire more people.
I mean, we can talk about that, but all right, let's just get our answers right. Question C. Same facts as A, except that instead of operating a sole proprietorship, Andy is a 50% owner in an LLC that provides electrical services. The LLC generates 208, coincidentally, $280,000 of revenue, incurs $40,000 of deductible expenses, and allocates all of its profits and losses equally between the two partners. So, where do we test 199A? And this is going to be, not shockingly, given the numbers, guys, the authors aren't dummies. Under Code Section 199A, F1A, one little I, I'll repeat. Code Section 199, capital letter A, F1, capital letter A, one little I, it yields the same outcome as in A. Okay, we're going to have the same outcome as in A. The author's point here is, don't look at the partnership, look at the individual partner and their pro rata share. Question 2. Chase is a 25% partner in a limited partnership that owns retail shopping center. The partnership purchased the facility 10 years ago for $10 million, $2 million of which is allocated to the underlying land. The partnership generates $1 million of rental income each year and pays employees $200,000 a year to manage the leasing operations. Assume Chase had sufficient income from his share of the profits from the partnership to subject him to the full range of limitations under 199A. Okay? So he's going to be subject to the limitations because he's a high income earner. Discuss the application of Code Section 199A to his distributed share of income from the partnership. All right, so bearing that in mind, and by the way, do you think the first limitation or the second limitation applies? Is this a labor-intensive or capital-intensive industry, guys?
Capital.
Capital, okay, capital. So we have to apply the limitation, and we either use 50% of W-2 wages, or we use 25% of W-2 wages plus 2.5% of the unadjusted basis. So figure that out, guys. Come up with a number. Figure out, without any limitation, what could the taxpayer deduct here? Without any limitation, what's the qualified business income here?
800.
800,000, right? It's $800,000, right? 1 million less $200,000 worth of salary. It's $800,000 of income. What's C's share? So the qualified business income
20. Sorry.
is equal to 800,000. And C's share is how much?
20. Well, his 50% share is 25K. 50% share of W2.
200,000, right? He's 25%, right?
Right.
So at least for the moment, the deduction could be a robust 40,000, right? But is it? Go figure out without me saying anything, take a moment, apply the limitation, see if you come up with will the limitations apply, or the limitation apply here? You want the greater of those two numbers. What are the greater of those two numbers? What's Chase's allocable share of the wages?
25.
Isn't it 50,000? The wages are 200,000. 25% of 200,000 is 50, right? So Chase's allocable share of the wages right, is 50,000. That's 50. What's his allocable share of the building? How much, guys?
200.
How much?
200.
Isn't it 2 million?
8 million from the 25%
2 million. Okay, so his allocable share of the building is 2 million. All right, come up with the limitations under both. You get the greater of what? Greater of, isn't it 50%, 0.5 times 50,000? So that limitation is 25,000, right? That's not good. He wants the $40,000 deduction. This was limited to 25. But he gets the greater of, what's the second limitation?
2.5% of.
Isn't it 25% of 50,000? 25% times 50,000. Right, which is 12,500. Plus, big plus sign, 2.5%, which is 0.025 of 2 million, right? Which is equal to 50,000, right? So what's 50,000 plus 12,500? The limitation here is 62,500, right? So what deduction can we secure? 40,000. In other words, these limitations don't apply, right? Because the maximum deduction is 40,000, and we could deduct up to 62,500. So we can deduct the full 40,000, right? Remember, those limitations only cap the amount of the deduction. They don't allow a deduction. They cap a deduction. They don't allow a deduction. All right? Question 3. Doc is a veterinarian, owns 25% of an LLC that operates a veterinarian clinic. Doc's distributed share of profits from the LLC is 120. She's not entitled to receive any guaranteed payments for her services. Okay? No guaranteed payments, so we don't subtract anything out. Doc's spouse earns an annual salary of $80,000 as an employee. Assuming Doc and her spouse file a joint return, do they qualify for the 199A deduction? If so, determine the amount of the deduction. First of all, are they is veterinarian services an SSTB? The answer is yes. It's involved in health. Okay, so this would be, but their combined income doesn't exceed the threshold. Agreed? So what would their deduction be here? Steve, you can have the honors because you should have this.
The deduction is 24.
24,000, right? Everyone agree? You had 120,000 of qualified business income times 0.2. You should be okay here. That's a healthy deduction. Question B says, suppose Doc's distributed share is 500,000. Can he qualify? No, game over. You're in an SSTB, code section 199A, D1A, and D2A. Code section 199A, D1A, and D2A disqualifies someone who specializes in income is beyond that threshold. No deduction permitted. Question C. So question C is beyond, really, in my opinion, gets more complicated than we need to for our purposes of this course. I'll just share this with you, but you're not responsible. It talks about assuming the same facts as B, except Doc also owns 25% in a limited partnership that leases a commercial facility exclusively to the veterinarian clinic. Will Doc's distributed share of the profits from the real estate partnership qualify for the deduction, assuming the limited partnership and LLC are owned by the same parties in the same proportion? And if you look at page 90, I'll just call this to your attention, is that on page 90, that first full paragraph on page 90 talks about aggregation principles, where the same people are involved in an SSTP and they also own real estate and they're owned by the same people. In this case, just for your notes, but again, I'm not going to hold you responsible for it, there would be no deduction allowed here. The deduction relating to the rental income would not qualify for Code Section 199A. Okay, last segment of this chapter, page 94. Limitation of partnership losses. As you guys have heard me say on many occasions, for gains, they must be realized and they must be recognized, right? Gains must be realized and recognized. For losses, losses must be realized, recognized, and allowed. And Congress is always circumspect with losses, right? Does not allow losses willy-nilly. And we're going to see, ultimately, that there's going to be 4 different limitations on permitting losses that come up routinely with partnerships. The first limitation is the basis limitation under Code Section 704D. That's the first limitation. And the oldest, 704D. And you can't get deductions in excess of your basis, okay? Cannot get deductions in excess of your basis. 704D. That's limitation 1. Limitation 2. You can only deduct up to the amount you're at risk. You can only deduct up to the amount you're at risk. But there's a big exception under Code Section 465. The at-risk rules are under Code Section 465. And there is a big exception for qualified non-recourse financing, so that you could drive a Mack truck through that exception. In other words, even though, if you recall, you have to be at risk, what does non-recourse suggest? You're not at risk, right? So Congress, in 1984, when they introduced Code Section 465, the real estate industry says, well, give us a break. We want losses with respect to non-recourse, qualified non-recourse deductions. Finally, in 1986, Congress said, you know what, just too much revenue is being lost to these passive losses. So in 1986, Congress introduces Code Section 469 that puts a brake on passive losses. So you have 3 different tiers: the basis rules, the at-risk rules, and then the passive activity loss rules. 3 different barrages. And then, just to make your life interesting, because that's what tax is all about, guys, is that in the 2017 Act, the last page on page 108 of our textbook, there's a new loss limitation, which we'll learn about more next week, Code Section 461L, okay? Puts one more break on the loss limitation rules. All right, so I'll just point your attention that over the course of the next few days, we're going to be looking at several different loss limitation rules, all right? So whenever taxpayers talk about losses, particularly in the partnership context, make sure that you don't just say, dwell on, oh, you have adequate basis, you should be allowed that loss. there are significant hurdles. I just mentioned 4 of them. And your clients are going to have to get through before they're entitled to get a loss. Okay? So bear that in mind. I'll call it maybe, I hope you share this opinion, the most straightforward one is Code Section 704D, dealing with the basis rules. And Anna, this relates to you can't have negative tax basis, so your losses cannot exceed essentially your investment in the property. If you do have a 704D loss and it's disallowed, you can carry that loss forward, okay? So that loss does not just disappear, it just gets carried forward. And the authors talk about the fact that you may, and we're going to see one of the problems illustrates this, if the losses are in the nature of ordinary loss and capital loss, you have to take a pro rata share in terms of deciding which loss is disallowed. It will be based on the size of the loss, and we'll see that in the last problem. So on page 95, guys, we have C and D are partners who share income and losses equally. C has an outside basis of $5,000 in his partnership interest, and D has an outside basis of $15,000. During the current year, the partnership has gross income of $40 and expenses of $60. Obviously, it's not been a good year, right, guys? Not been a good year. What are the tax results to C and D? So remember, C has an outside basis of $5,000. Okay, D has an outside basis of we said D has an outside basis of 15. And the partnership, as you recall, has a loss of 20,000. Everyone agree? Everyone can handle the math even after a few hours in partnership tax. We know partnership has a $20,000 loss. That's allocable $10,000 to each partner. Agreed? Well, allocable. I didn't say allowed. I said allocable. Okay? And we know D can get the full loss, right? Because D has adequate outside basis. So putting aside the other limitations, at least for the moment, at least on the face of it, D can command a $10,000 loss. By way of contrast, C can only command a $5,000 loss. Okay? And C is, that you're alluding to, has to carry forward the other $5,000 worth of loss. And these losses, what triggers the reduction of basis? Recall, Code Section 705A2A. I'll repeat, 705A2A says that if the partnership has a loss, you reduce outside basis. So at the end of the year, C has a 0 outside basis, D has a $5,000 outside basis, and C gets to carry forward that loss. If you look at 704D, D2, does it carry over the loss? Question B. What results to C and D? In the succeeding years, this B, the partnership has income. So in this case, we're told that they $10,000 eligible to each. So C would have a carryover of the $5,000 loss. So C would only have to report $5,000, right? And so his basis would increase by 10,000, excuse me, would then be reduced by 5,000 because of the allowable loss. And D's basis would go up to 15,000, right? That's 705A1A. So C's basis here would become 5,000. D's basis would come back up to 15,000. Question C. How might C have alleviated this problem?
Put in 5,000.
Say again?
Put in 5,000.
Make a contribution, right? Contribute. Can't use a note. Couldn't just simply, this is not like corporate tax where in corporate tax you might be able to contribute your own note. There is case law that you cannot just contribute your own note. Also, if the partnership took out a liability, right? Code section 752, if the partnership took on a liability, 752 would raise outside tax bases, right? Question D. What results in A if the net $20,000 loss consists of $50,000 of ordinary loss and $5,000 of long-term capital loss? Well, this relates to, on the top of page 95, you're going to do a pro rata allocation. This relates to, by the way, I'll just write this down for your notes. There's an example in the regulation 704-1D4, example 3. And what would happen here is, keep in mind C would get allocated 7,500 of the ordinary loss, right? And 2,500, I should put a 2,500 of the long-term capital loss, right? Well, I should say C's portion of that is 3,750, and because where does this come from? 7,500 over 10,000 times 5,000. This is 2,500 over 10,000 times 5,000. This is 7,500 over 10,000 times 5,000, and 2,500 over 10,000. All we're doing is allocating the permissible loss and what has to be carried forward, guys. You can check me on this, and we can, at the beginning of next class, go through this again. But all I'm doing is doing the same thing the authors did on the top of page 95. Because he's going to be allowed, he's going to be permitted $5,000 of permissible loss and $5,000 of carry forward, right? So we're just taking a pro rata share of each. All right, final question. What result to S, C son, and A above, if C gives his interest in the partnership to S on the first day of the year in which the partnership has profits of $20,000? And we know the son under Code Section 102A doesn't have income. We know Code Section 1015 that the son takes a carryover tax basis, right? Takes mom's outside tax basis. What the authors are implicitly asking is, remember, in problem A, C had a $5,000 loss disallowance which was carried forward. Agreed? And the question is, can the son step into mom's shoes and get that $5,000 carry forward loss? And the answer is no. That's like the flip side of the assignment of income doctrine. You can't have the assignment of deduction doctrine. So mom can't plant the son with $5,000 of deductions, right? So this would not fly. right? Now, again, this is just the first step in an analysis, the basis rules. The at-risk rules, guys, let me call certain things to your attention. If the loss is disallowed, there's a carry forward under the at-risk rules. So in other words, if the at-risk rules apply and a loss is disallowed, the loss is not forfeited, just like the basis rule, it's carried forward. And then I want to call to your attention on page 96. Look at the first full paragraph, the last line. If a partner's loss is deferred by Code Section 465, the partner's outside basis is nevertheless reduced by the amount of the loss. Okay, and they say that's footnote 104. That's a regulation. So I just want to point out, even if the loss is disallowed, outside basis still gets reduced. The next sentence on page 96, the next paragraph, it starts off, a partner is considered at risk with respect to his share of partnership recourse, not non-recourse, recourse debt. Page 97 discusses what is qualified non-recourse financing. Again, this is a big loophole that, notwithstanding it's non-recourse, right? Non-recourse means that the lender cannot go after the partners, right? So it doesn't seem like they're at risk. The code permits this whopping exception, right? Compliments of the real estate industry back in 1984. So qualified non-recourse financing, major exception. Okay? So we're going to see how that plays a role here. And then on page 98 and 99, what effect does it have to restore a deficit capital account? Does that make you at risk? And essentially, my takeaway, the reading on page 98, 99, is that no, that the fact that you're liable to restore a deficit to a capital account will not qualify you to avoid the at-risk limitations. I repeat, the fact that you or your client has some sort of deficit restoration obligation under the capital account does not make you at risk, or does not make your client at risk. All right? So, let's just do one problem, final problem of the night, guys, just to give you a taste, and we'll revisit this at the beginning of next class. Page 99, one problem. LP is a limited partnership, or a limited partner, in a newly formed partnership which is engaged in the following activities. A research and development activity to which LP contributed $10,000 in cash. The limited partner's share of the partnership non-recourse liability attributable to this activity is $10,000. And LP's share of the loss of the research activity is $12,000 for the current year. And a different activity, a motion picture production activity, contributed $20,000 to cash. And LP's share of the income from the activity current year is $25,000. LP's outside basis at the beginning of the year is $40,000, and his net share of the net gain for the taxable year is $13,000. Where did the $13,000 come from? Remember, we had a $12,000 loss and $25,000 of income. If you do the arithmetic, that's where the $13,000 comes. Why did the authors show gain and loss here? Because the authors wanted you to know, as we'll see in the next part, that the passive activity loss limitation rules didn't apply. In other words, notice the passive income here is $25,000, and the passive losses here are $12,000. So what that means is Code Section 469 does not apply to this problem, because you have passive income in excess of passive losses. I repeat, in this problem you have passive income in excess of passive losses, so Code Section 469 does not apply here. So if there's going to be a limitation, it's going to be under 465. It's not going to be under 469. All right, so that sets the tone, guys. I know you're not going to absorb much if I keep talking, so let's just take a quick look and then we'll close the book. Page 100 talks about the passive loss limitation rules, which we'll discuss. And then page 108 talks about this new limitation. Let me just warn you, chapter 4, guys, chapter 4 is a challenging chapter, okay? Very challenging, but doable. You really have to spend, I can't tell you otherwise, you have to spend a long time going through this. There's no shortcuts, okay? There is no shortcuts. If you could read, it's ambitious. I don't think we'll get there, but we possibly can because there's a lot of reading, not a lot of problems. Can you read up to page 162? Very ambitious, all right? So I will see everyone on Wednesday of next week. Look for that Evite. I hope most of you can attend, October 26th. And we'll see you next week. Any questions or problems, let me know. Those people on WebEx, have a good night. And I would say to the people on WebEx, have a safe drive home, but they're probably home.